Imagine a clock ticking in Times Square. It's been running since 1989, and it only tracks one thing: the US national debt. Today, the debt has exploded past $38 trillion. It's growing 3 times faster than the entire US economy. Most people see this as a looming disaster, a fiscal snowball rolling downhill, picking up speed and size until it crushes everything in its path. But there is one firm that doesn't just watch the clock, they manage the mechanics behind it. That firm is BlackRock. With over $11.6 trillion in assets under management, they are the largest asset manager on the planet. While the government struggles with soaring deficits and risky safe assets, BlackRock is rewriting the rules of the global financial system. They've built a Washington Playbook to avoid regulation. They're positioning themselves to own the world's infrastructure, and they're even finding ways to profit when other nations fall into debt distress. Is BlackRock the prosperity flywheel that will save your retirement, or are they the shadow government that has quietly taken control of the debt crisis? Today, we're breaking down exactly how BlackRock uses America's debt crisis to expand its power, its profits, and its influence over your financial future. To understand what's happening, you have to understand the risky safe asset. For decades, US Treasuries, the bonds the government sells to fund its debt, were considered the safest investment in the world. But that's changing. We are now in a regime of persistently high deficits and elevated inflation. The US is running historically large peacetime deficits with absolutely no sign of restraint. This has created a massive problem for the government. They need to sell more bonds to pay their bills, but foreign demand is drying up. Foreigners are looking at currency-hedged treasury yields and realizing they can get better returns in Europe or Japan. Even domestic buyers, regular Americans, aren't getting enough risk-adjusted yield to justify holding long-term debt. BlackRock calls this a challenging fundamental backdrop. But where others see a challenge, BlackRock sees an opportunity. They aren't just a traditional asset manager anymore. They have transformed themselves into a global power player that stands alongside banks and governments as a co-equal source of capital. The story of BlackRock's dominance starts with the 2008 financial crisis. While the world's biggest banks were failing, the US Treasury turned to BlackRock. They loaned the firm $1.4 billion and entrusted them with managing the toxic assets of Fannie Mae, Freddie Mac, and AIG. BlackRock became the central processing unit for the disposition of the crisis. Emerging from 2008 as a $3 trillion giant, BlackRock's top priority was simple: stay unregulated. They desperately wanted to avoid being labeled a systemically important financial institution (SIFI), better known as too big to fail. This label would have brought heavy government scrutiny, capital requirements, and liquidity standards. So they launched what researchers call the Washington Playbook. From having almost no lobbying presence before the crisis, BlackRock built an in-house lobbying team dominated by former government officials. Out of 18 registered lobbyists, 11 previously held jobs in the SEC, the Treasury, or the very committees in Congress that oversee the financial industry. They spent millions on campaign contributions, strategically favoring whichever party was in power. Between 2008 and 2018, they poured over $720,000 into members of the House Financial Services Committee alone. They met with regulators on 18 different occasions during the debate over their SIFI status. In the end, they won. The government altered its approach, allowing BlackRock, the world's largest asset manager, to forgo additional regulatory oversight. This lack of oversight allowed them to grow even larger, eventually managing more money than all the world's hedge funds combined. By the time the 2020 pandemic hit, BlackRock was so integrated into the system that the Federal Reserve hired them to oversee 3 separate debt-buying programs. They were no longer just participants in the market, they were the market's referees. As the US debt grows, BlackRock is eyeing a strategy called financial repression. This is a historical trick used after World War II to melt away massive debt loads. The goal is to keep interest rates on government debt below the rate of economic growth. Think of it like an interest snowball. When interest rates are higher than growth, the debt grows uncontrollably. But if you can cap those interest rates, essentially monetizing the debt, the government can slowly deleverage. In the past, this involved Regulation Q, which capped interest rates for the private sector, and the Fed explicitly capping Treasury yields. For you, this means lower real returns on your savings. It's a way for the government to crowd investors into sovereign bonds at the expense of the bondholders. BlackRock analysts note that as debt-to-GDP levels rise, central banks often take over a larger portion of that debt. They've pointed out that there is plenty of room for the Fed's ownership of Treasuries to expand, especially under a pliable Fed chair. By identifying these themes early, BlackRock positions its portfolios to navigate a world where traditional bonds no longer offer protection. They are moving away from duration long-term bonds and toward carry and high-quality credit. They are preparing for a kick-the-can scenario where deficits persist and yields grind higher, forcing investors to look elsewhere for income. This brings us to the biggest move in BlackRock's history, the $68 trillion infrastructure boom. Larry Fink, BlackRock's CEO, argues that governments can no longer fund infrastructure through deficits. The debt is simply too high. Instead, they will have to turn to private investors. Infrastructure is the ultimate debt crisis play. By 2040, the world will need $68 trillion in new infrastructure, everything from power grids and ports to AI data centers. To put that in perspective, that's like building the entire U.S. interstate highway system and the Transcontinental Railroad every 6 weeks for the next 15 years. BlackRock has spent the last 14 months transforming itself to own this space. They acquired Global Infrastructure Partners, GIP, which owns assets like London's Gatwick Airport and massive data center networks. They also moved into private credit, acquiring HPS Investment Partners, because companies are no longer relying solely on banks for loans. For BlackRock, this is about the 50/30/20 portfolio. They believe the future of investing isn't just 60% stocks and 40% bonds. It's 50% stocks, 30% bonds, and 20% private assets like infrastructure and private credit. Why? Because infrastructure offers inflation protection. The tolls and utility payments these assets generate typically rise along with inflation, providing a stable return even as the dollar's value fluctuates due to the debt crisis. They are essentially positioning themselves to be the world's landlord and utility provider. When you pay your power bill or a shipping container moves through one of the 100 ports they plan to control, BlackRock's clients, and BlackRock itself, collect the fee. But it's not all prosperity flywheels and stable returns. There is a darker side to how this game is played. While the U.S. deals with its own debt, BlackRock is making billions from the global debt crisis. Research shows that BlackRock and its clients stand to make $2.1 billion in profit from loans to lower-income countries that are in, or at high risk of, debt distress. While countries like South Sudan struggle to feed their populations, private lenders are being paid in full at high interest rates. These lenders claim the rates are high because the loans are high risk, yet they rarely offer debt relief when a crisis hits. Back in the U.S., BlackRock's own private credit empire is showing signs of stress. As of early 2026, a crisis has been spreading from shadow banking to traditional institutions. High-profile private credit holdings have triggered market panics. BlackRock recently had to write down a $25 million piece of junior debt to zero and imposed a 5% redemption limit on its $26 billion HBS corporate loan fund. When BlackRock wrote the debt down to zero, it was described as the final straw that broke the market's back, triggering more redemptions and a vicious cycle of falling prices. This domino effect has forced other funds to close the gates to stop investors from pulling their money out. It's a classic contagion phenomenon where liquidity issues in one corner of the market begin to threaten the core of the global financial system. Key insight: the most important takeaway from BlackRock's strategy is this: the debt crisis isn't a bug in the system, it's the feature that allows them to replace traditional banking. By leveraging their political influence to avoid regulation, they have positioned themselves to step in when the government and banks can no longer afford to lend. They are moving the world's wealth from transparent public markets into opaque private ones where they hold all the data and control all the gates. Why it matters? Why should you care? Because your retirement is at the center of this shift. More than half of the $11.6 trillion BlackRock manages is retirement money. They are pushing to include private assets like infrastructure in 401k plans, arguing it could fund an extra 9 years of retirement. But these assets are unfamiliar territory for most providers. They don't have daily valuations, and you can't just withdraw your money whenever you want. Furthermore, if the U.S. doesn't get its debt under control, BlackRock's leadership warns that the dollar could lose its status as the world's reserve currency. They are already preparing for this by championing tokenization, turning every stock, bond, and real estate asset into a digital token on a blockchain. This would make markets faster and cheaper, but it could also allow investors to see Bitcoin or other digital assets as a safer bet than the dollar if the fiscal situation continues to deteriorate. So, the Real story isn't just about a company managing investments. It's about how BlackRock has used the US debt crisis to build a new kind of global architecture, one where they manage the government's debt, own the public's infrastructure, and influence the laws that govern their own empire. What happens next? BlackRock is betting on economic democracy, a world where everyone owns a piece of the economy through their smartphone. But as they bridge the divide between public and private markets, we have to ask, who really holds the power? If the US debt clock keeps ticking toward a permanent deficit by 2030, BlackRock won't just be watching. They'll be the ones holding the keys to the only system left standing. The prosperity flywheel is spinning faster than ever, but whether it's working for you or for the titans of Wall Street is the multi-trillion-dollar question.